morning. Since we are live streaming, I thought I would let everybody in on why we're waiting. We had some late exhibits that were submitted in this case, and so we've been trying to get them copied and into exhibit binders this morning, and so we're just waiting for that little piece to make its way down here, downstairs, and we'll get started then. Looks like we're ready to begin. Ms. Lopez, can you please announce the first case?
Okay, our first case today is Peter R. Small and Tracey Tyree-Small, 1801-1159.
Okay, good morning. We have a few preliminary matters before we go on the record. And when I say on the record, what I mean by that is that we'll be recorded. We have a stenographer here today. So can we please have, who is here today? Mr. and Mrs.
Peter Small.
Peter Small. Tracey Small.
David Kowalczyk for respondent.
David. Okay, and up here, I'm Teresa Stanley. I'm the lead administrative law judge for this hearing. We are a co-equal panel, and we will all three be deciding this case together. This is Jeff Margolis, and I've got Grant Thompson here. We have some exhibits that we've agreed upon pre-hearing, and then there are some exhibits that were submitted since then. At the pre-hearing conference, we had two exhibits that were accepted by respondent and appellant, and we had A through J for respondent that were approved by both parties. Additionally, we didn't put them in the exact same order that they were submitted to us. We tried to make a little bit of sense of it. So you can look at the appeals log that we've attached and see the additional documents. And I'll ask the Franchise Tax Board if they have any objections to any of these documents.
No objections.
Okay, so when we go on the record, we'll be admitting exhibits 1 through 12. And there are no additional things that people expect to submit today. Mr. Small, no? Okay. We also have an issue statement about whether appellants have shown error in the Franchise Tax Board's determination that Mr. and Mrs. Small are not entitled to their claim mortgage interest deduction for the residents in Gilbert, Arizona for taxable year 2011. Do you still agree that that's the issue? And
yes.
Respondent? Okay. And Mr. and Mrs. Small, will you both be testifying today, or just one of you taking the lead, or? She's going to take the lead, and you'll chime in if you need to.
Yes.
Okay. And Mr. Kowalczyk, you don't have witnesses today, correct?
That's correct.
Okay. All right. Then let's go on the record here. Stenographer is ready. Okay, this is the appeal of Peter Small and Tracey Tyree-Small, case 1801159. This is December 18th, 2018. We're beginning at about 9:18 a.m. in Sacramento, California. And just a little preliminary thing, mostly for the appellants who haven't done this before, is that the Office of Tax Appeals is an independent organization. We're not affiliated with the Franchise Tax Board or any other tax agency. So we'll be making an independent analysis of the case that you've already submitted, the facts that you'll submit today, the argument that each side will give, and then we'll make a decision after that. Do you have any questions? No? No questions. There. Okay. We will, to restate the appearances today. Go ahead and state your appearances on the record this time.
My name is Small.
Tracey, Tyree-Small.
David Kowalczyk for respondent.
Nancy Parker for respondent.
Thank you. And once again, I'm the lead administrative law judge, Teresa Stanley, and I have Judge Jeff Margolis and Judge Grant Thompson with me today. The issue for today is whether appellants have shown error in the Franchise Tax Board's determination that they are not entitled to their claimed mortgage interest deduction for the residents in Gilbert, Arizona for the taxable year 2011. We will admit into evidence appellants exhibits 1 through 12 and respondents exhibits A through J. So they're all admitted without objection. At this time, I believe when we had our pre-hearing conference, we discussed the fact that since you're not having any witnesses other than yourselves here today, that we would not need to do opening arguments, which is just a way of telling you what you're going to tell us. So if you don't, if you're still okay with it, then I'd say let's jump into the testimony. That's all right with you both? Okay. So I'm going to ask, just in case Mr. Small testifies as well or chimes in, I'm going to ask that both of you stand and raise your right hand. Do you solemnly swear or affirm that you will tell the truth, the whole truth, and nothing but the truth? And you can sit down. I'm just going to point out that our stenographer records words, so I need to hear you guys when you respond to me, okay? Is your microphone not on?
That working?
No, it doesn't appear to be.
Leave that one alone. It's the green button. Press the green button in front of the microphone.
What? Can you hear me?
Mr. Small, is your microphone working? Maybe we need to slide over. Yeah, yours is working. If you want to slide over, Mrs.
I think
Small.
just slide a little closer might work.
Okay, swap. That'll work. Okay, you can. We're not going to be really formal with this, Mrs. Small. You can just tell us why you think that you should win this appeal, and maybe describe and explain the new exhibits that you've submitted to the panel.
I have to hold the button in, or you can hear me?
No.
Oh, no.
You can hear me?
No, we could hear you when Mr. Small talked, but now you've done something to it.
You just need to press the button. Don't hold it.
Okay. How about now? Bring your microphone.
Yes.
Okay. Good? All right. So in 2011, myself, my husband, and my sister-in-law we bought a property prior to 2011 together, and we made an agreement with ourselves that we would take the tax return. We would do the tax return, and she basically lived in the house. So we've all shared and pay a mortgage and things like that. But we thought that the agreement between us three would be okay, and we found some information supporting that. It doesn't, so that's what we did basically. And we have I think the reason that we were turned down is because it showed her name on the 1098, and it didn't show ours. And so we went back to the bank and we talked to them, and then they were able to produce with all three names on there, which is one of the things that we submitted along with the package. And so that's why we think that there was an error, and possibly because it didn't see all three names. and that's why we're here.
Okay. Mr. Small, do you have anything to add to that?
Well, exactly what she's saying is 2011. I think there's a document that's missing that we couldn't get. We tried to get it from the bank, and basically when the bank submitted that the 1098 original 1098 that they submitted to us, I think it's only one name was on there, and it was my sister's name. But the bank, I went back to the bank, and they said the only document they had was this. And I think that's where this whole thing with the state came into being. They're basically saying we're not entitled to this, to claim the interest on the property. But we've been making payments, all three of us. We came together, like she said, and we decided that we'll get the tax write-off. My sister will live in the property. She'll take care of the property. At the end, whether we sell it or get rid of it, that's what it's going to be. We'll just share the yeah, and we share the costs on that property.
Okay. Anything else? I'm just giving you enough opportunity. I don't want to force you to speak if you're done. Okay. Mr. Kowalczyk, do you have questions?
No questions.
Mr. Margolis, do you have any questions?
Yes, I think I have two questions. One is the IRS audited you regarding this, I believe. What was the result of the IRS audit, and did that disallowance stand?
No, they didn't reject us, only the state.
Okay. And on paper, are you a co-owner of the property, like on title?
Yes.
And did you bring any documents to show that, or?
It should be listed on the 1098, all three names, and there should be some information in here that supports with all three names.
Okay. The 1099, it goes to the interest. I'm just wondering, when you went to the recorder's office and when you purchased the property, were your names on those documents as well?
Yes.
Okay. I think that's it for me.
Mr. Thompson?
No questions.
Okay. If after following the questions, do you have anything else to add? No? I'm just giving you ample opportunity. Again, I'm not forcing you to speak. Okay, then let's turn to the Franchise Tax Board and reaffirm that they have no witnesses that they're going to present today, no case?
That's correct.
Okay. Then we have an opportunity for you, again, to speak. If you have anything else to add to what you've already said, you can do that in a conclusion statement. But I will let you know that we do have all of your exhibits now. We've reviewed them, probably a little more cursory for the ones that were just submitted, but we will certainly review all of them before we make a decision. So if you don't have anything else that you think you need to add, we can move to the Franchise Tax Board.
In basics, I think that the documents that are all supported in what we're saying should show the matter that it's clear-cut. There was 3 owners. Legally, we're allowed to make a decision amongst the 3 of us how we want to take care of the property, and we have enough supporting evidence. So,
Also on the 1098, the bank told us that in the place where they have the taxpayer's ID, that they could not put all of us in that block. So they could only put one person, and they chose Jackie, my sister, for that tax ID number. But they did listed myself and my wife down the bottom of that document.
Yeah, and the one that you submitted, though, I believe it does have all 3 names on it. The 2011 one mortgage loan statement, which would be exhibit number 12 at this point, even though it's not marked that. And then there was another statement in there, so we don't need to focus on the 2012 statement that is irrelevant to this year and only has one name on it. And Judge Margolis has one more question, if you don't mind.
Since these documents just came in, the new documents you brought in, they actually show that these payments on the property were by you as opposed to by your sister. Is that correct?
Well, they were.
No. It was actually a combination of the three of us. Now, I went back to the bank and asked them because some of the payments were made in cash and some were made by check. I went back to the bank and I asked them for if we can obtain that, and it says they don't store that kind of information for that period of time. And so it wasn't available to us.
They just have the summary of all the payments listed, but they don't have how it's broken down. That was the best we could get.
So between the three of you, was there how much of the payments did you make versus your sister make?
Well, I don't know, it's 2011, but there were different things like, for example, not just mortgage, but there was a problem with, what's it?
Well, basically it's the convenience. That sometimes she would make the payments because of convenience of her. She would call us and says, hey, you guys make the payments this month or whatever. Or she would do it sometimes from Arizona. So it was being made in both locations, California and India.
But also what I was going to add is there's been like issues like termites and things like that. We would take care of it, or just different things throughout the whole life of this whole thing. And all of us share responsibility and payments for those type of things. So it was like a give and take on different matters, that mortgage, termites, whatever the case came up, we would share the responsibility. So.
But some of the payments you did send in by check. So you did pay some of the mortgage payments by check.
Yes.
Just a quick question. When you mentioned payments by cash, you just physically walked down cash to an office, or how did that work?
No. Basically, I took the money out of the bank, but I have different accounts, and basically took it from my credit union. I would actually take the money from my credit union, and then I would go into the ATM machine, take the money, and then go into the bank and pay them the bank the actual money.
You would actually withdraw it and walk in the bank.
Yeah.
Okay.
Because I only have one account, and I have a credit union account, and that's how I did it, because it was more convenient for me to do it that way.
Thank you.
Did you ever try to go back and get bank statements to show which payments you made?
And all they were able to give us was the summary of the payments. It didn't break down by who made what. It just was like a summary of just payments. And that's submitted also. But we did ask for that information and we couldn't get it.
Yeah, I mean like your own bank statements. Like Mr. Small, you said that you'd go into your credit union sometimes and withdraw payments. Did you ever try to get those bank statements too?
Yeah, I did not. I tried to pull that up also, and I couldn't get to that. I actually asked the credit union if they can help me in that respect, and they could not pull up for some reason. I don't know. Maybe I didn't go to the right person or whatever, but we could not get them to get that far back. They said something in the effect that they don't keep records from that period of time to show, deposits. I went in there personally and I looked, and I went as far back as the system would allow me to go. And I got to that point, and that was it. There was nothing showing 2011. It was too far back. And I called them and I asked them, and they says, no, we don't do any kind of transaction. We don't track that. all the way back to that date. So that's the only thing that I've got on that.
Okay. Questions?
No, nothing further.
Just one more background question. So this is one of two properties you own, is that correct? Just making sure.
Yes.
Okay. Given the questions that we've had, do you have any follow-up questions, Mr. Kowalczyk?
No follow-up questions, but respondent requests a recess to discuss the new information.
Okay. 15 minutes good?
Yes, thank you.
Okay. We'll give a 15-minute recess. find something. I email it to myself, take my mask, go back to my...
Yeah, I'm fine. I'm enjoying it. I'm usually taking care of, but
Have to do homework, Tracy.
it's an
Right.
outline for potential questions
Then
and
it's in
answers.
here.
Yeah. And then you always get something different.
Big boo-boo by not reading mine the other day.
Well, you saw, maybe you were on the panel, but
And I didn't want to say, oh, they all look alike.
Mike said he blanked on Sarah's last name. He was like, this
Judge
is...
Sarah.
Yeah, he was like, yeah, this is Judge so-and-so, and this is Judge. And then just total brain freeze.
Yeah, when
was scared. I was always scared before like my flight would be delayed or canceled. You know,
When you're going that early in the morning, it's the first flight of the day, so usually not delayed. Weather issue. Got a little bit. I guess I was a little less worried about LA traffic because half-hour drive from LAX to but I had 3 hours to do it, so
yeah. So they got, yeah.
figured I'd be okay. So she didn't have far to go. But the other instead of 2.
It's like a tailwind.
I get my script. It's kind of late.
Oh, I didn't think of that. Yeah. You can't pull it up on what?
Oh yeah, yeah. Actually, I do have it. It and everything else.
So I usually pull up the briefing and correspondence and then the emergency regs for right now. So I always have those open as a security blanket.
I want my SpongeBob blanket.
That's right. I used to go to the hearings and I would have like all these papers all around me, you know, and I don't think it looked very good. So like the computer's better. I would joke it's like a protective shield.
I went to the trouble, since I was working at home, I went to the trouble of emailing it to myself so that I could go to my home computer and print it on my home printer.
Oh no.
Which is why I don't get it.
Oh, here it is. They've interchangeably used Mr. and Judge, but I think that's just fine.
That's fine. I think
frankly.
it's actually probably preferable.
Yeah. Mark were in the room, I would have tried to say Mr. more, but but it's weird. It's what our nameplates say, so why can't we use that?
I know. Yeah.
Opening statements, swear them in, questions, Mr. Thompson, Mr. Margolis. Oh, here's one thing I forgot. That even though their panel notice listed Doug Bramhall.
Oh, it's okay. We announced, yeah. I think it worked out better. Like often.
Nobody objected.
Yeah, everybody's on notice. Questions. I worry about questions.
going back on the record in the appeal of Small, first I wanted to ask the appellants one question, and then I understand that based on the answer there may be a stipulation in this case. So Mr. or Mrs. Small, can you please describe how much of the mortgage payments you believe you made in 2011?
So it's just an estimate, but we're estimating we paid at least 50%. And just to be fair to our sister-in-law, we just want to make sure we split it instead of trying to figure detail out.
So you're saying at least 50%. Okay. Do you have any follow-up questions for that, Mr. Kowalczyk?
No. Just that respondent agrees that appellants should get 50%.
Okay. So the stipulation is that the Franchise Tax Board is going to allow a 50% mortgage interest deduction for tax year 2011 to the Smalls themselves.
Correct.
Okay. Then is there any other detail that needs to be addressed? I mean, that is the sole issue in the case, is whether they're entitled to the deduction. Do you agree with that and accept that you would get a 50% deduction? Mrs. Small says yes. Mr. Small says yes. Okay, and Franchise Tax Board, you said agrees to that. Okay, then I don't see the need for closing arguments unless either of you does. Then we'll adjourn this appeal, and we will issue a decision that will reflect the agreement of the parties. Okay?
Thank you.
Thank you. And thank you both sides.
I'm sorry. Yeah, you can.
Hoover. We'll take the Hoover matter next. just want to note that in the Hoover appeal, we are giving the Franchise Tax Board a few minutes because they have just now received some late filed exhibits and they'd like to review them. So we're going to give them time to do that.
I understand how this is set up, right? Okay. 1 through 3 was yesterday, and this scratched off K was today.
This was
Yeah. So.
ask Ms. Lopez to please call the next case.
Okay, the next case is Jamie R. Hoover, case number 180111066.
Thank you. And this morning we have with us for the appellants,
Lisa Powers.
the Powers, and for Respondent Franchise Tax Board,
Samantha Nguyen.
Marguerite Meunier.
Okay, and although the notice of panel said that Amanda Vasig was going to be on joining us today, she's unavailable. So I'm the lead administrative law judge, Teresa Stanley. I'll be leading this, but as a panel, we are co-equal in our decisions, and we will be deliberating and deciding the case together. I have with me Mr. Jeffrey Margolis and Mr. Andrew Quee. And the issue that we have today is whether appellant is entitled to interest on overpayments for taxable years 2001 through 2006 inclusive from the dates of payments through the original return filing dates. Ms. Powers, do you still agree that that's the issue today?
Yes, and pointedly that RTC section 19341D does not apply in this instance, in this case.
Okay. And just so you know, this is before we go on the record, so I don't know if you're I don't know if you're recording it. I thought I heard some recording going on over there. And just some housekeeping, since we've had new exhibits that were submitted, or potential exhibits, we had at the pre-hearing conference, we had agreed that appellants exhibits 1 through 13 could be admitted into evidence. Franchise Tax Board 1 through 13, are those still okay? You still have no objection?
I believed after I received the minutes and the exhibit log, we had clarified that there should have been an additional exhibit 14, the statement of income tax changes, that was inadvertently made a part of exhibit number 5.
Yes, you are correct. So exhibit statement of income tax change, statement of income tax.
Statement of income tax changes. That was 1 page.
That's one page, and we were going to put that as exhibit 14.
Yes.
And we did discuss that at the pre-hearing conference. Okay, so exhibits 1 through 14, including the statement of income tax changes that'll be pulled out of exhibit number 5. Those are still acceptable to the Franchise Tax Board?
Yes.
Okay, and then on respondent side, there were exhibits A through N, as in Nancy, and Ms. Powers, you didn't have an objection to those at pre-hearing conference. I take it that still stands?
Yes, it is.
Okay. So exhibits 1 through 14 for appellant and exhibits A through N for respondent are going to be, appellant. 1 through 14 for appellant, A through N for respondent will be admitted into evidence when we go on the record. But I wanted to talk about the things that were additional proposed exhibits that were submitted. With respect to the exhibit list or binder that you guys have, or the set of papers, they were marked as 1, 2, and 3 with red flags, and then there's also an exhibit K, a potential exhibit K. These are out of order, so let me take them. Exhibit or the one marked as Exhibit 1 is a letter from the appellant with a legal statement. What is your position on that one?
We object to what's marked as Exhibit 1. It does not appear to be evidence, it's legal argument. And my understanding is that your office has not requested additional briefing from appellant?
That is correct. So what I would like to do with that, and actually I'm going to lump in what is number 3 listed there. I assume that you have the same objection to that.
Correct, number 1 and 3.
And Ms. Powers, I believe that they are correct. This is argument. It's not factual evidence that supports your case. So I would still, what I'll do is just call it supplemental material. I'll give you time to respond to it. If you prefer that she repeat this all in her closing statement, we could do it that way so that you could adequately address it in your closing, or I can just accept that since we can do independent legal research anyway as just supplemental information.
I think we're concerned about the late date to get this legal argument, and particularly the case citations and discussions of cases that are included. We don't have adequate time sitting here today to review them and respond appropriately if they are considered, part of her argument. They may in fact not be relevant, but we wouldn't have an opportunity to make that determination. And that's why we ask that your office just disregard them entirely.
Okay, let's put that aside for now. If any kind of law that's submitted to us or that we independently research, we have the authority to take that into consideration anyway, with or without a response. It's the law is the law. So if it's relevant law, we'll consider it, and I'll ask that Ms. Powers reiterate what she's put into these documents in her closing argument so that you have hopefully some time to at least address it in your own closing.
Thank you.
And then with respect to what's marked as number 2, that appears to be the doctor's letter that was referenced in other briefing. Do you have an objection to that?
No objection.
Okay, so that one, we'll take what's marked as 2 and turn it into Exhibit 15. And we'll admit that when we go on the record also. And then there's one more that's in an oddball place called K. That's the letter from Mrs. Hoover, appellant's wife. What's the Franchise Tax Board's position on that?
No objection.
Okay, so we'll mark that instead of K, we'll call that Appellant's Exhibit 16. Okay, and just one more follow-up thing on the legal, what is basically a supplemental brief. To the extent that the panel, we haven't reviewed it either because it wasn't submitted to us a long time ago either. So to the extent that we believe we need a response to any of it by Franchise Tax Board that you aren't able to cover at this hearing, we can make the decision to reopen briefing and ask you for a response to it if we feel we need it. Okay?
Thank you.
All right. Then let's go ahead and go on the record now. And once again, this is the appeal of Jamie R. Hoover, case number 18011-066. The date is Tuesday, December 18th, 2018. It's about 10:30 a.m. The location is Sacramento, California. I'm the lead administrative law judge, Teresa Stanley, and my co-panelists are Judge Jeffrey Margolis and Judge Andrew Quee. The issues that we have today are twofold, with the whether appellant is entitled to interest on overpayments for taxable years 2001 through 2006 inclusive, from the dates of payments through the original return filing dates. And Ms. Powers has an additional issue where she believes that section 431D should not apply in this case. Revenue and Tax Code section 19431D should not apply.
19441.
It is 341. And I read something. Okay. Just to make sure that we have on the record who is here with us, for appellant, we have
Lisa Powers.
And Mr. Hoover is not planning to appear today?
No, he lives in Seattle, and he decided not to. He has a child, and et cetera.
Okay. And for the Franchise Tax Board?
Samantha Wynn.
Marguerite Meunier.
Thank you. Okay, as we determined off the record, we are going to enter appellant's exhibits 1 through 16 into the record without objection. We are going to enter respondents' exhibits A through N into the record without objection. And the additional statements of law and cases that were submitted by appellant will be addressed during argument, and if the panel needs extra briefing from the Franchise Tax Board after we review it, we'll reopen briefing for that purpose. Okay, so Ms. Powers, since you have no witnesses here today, it doesn't seem like an opening and closing statement would be helpful at this point. So if you just want to basically summarize your argument about why Mr. Hoover should win this appeal, that would be helpful to us. And since you submitted that new information, if you could try to address that in your argument as well, so that the Franchise Tax Board has an opportunity to respond to it.
You want me to address that now, is what you're saying? So not
yes.
in closing?
Right. We're going to jump straight to closing because there are no witnesses.
Yeah.
Franchise Tax Board, you have no witnesses, right?
No witnesses.
Okay.
Sounds fine.
So rather than having an opening and an opening and a closing and a closing, let's just jump to closing. And
perfect.
It's a legal issue anyway, so
yes.
That's helpful.
I agree. Thank you. So the reason why the appellant does not think that Code Section 19341, or is it 19431? 19341 D, which is subsection D, or subparagraph D, is a limitation that limits interest on a taxpayer's overpayment in the case of a late return to the date that they actually file their late return. And what it is it's an enforcement weapon or tool that tax agencies have. IRS has one too, to punish a taxpayer for failing to file timely. And that's a reasonable assumption. I don't disagree with it. I think the law does its best to be fair in all instances. I think that in the case, however, of a financially disabled taxpayer, as defined in IRC 6511H and under RTC 19316, that this is a very narrow application of the situation in their instances, and that the standard statutes applicable on a mass application basis to all taxpayers do not necessarily apply to these taxpayers, and they specifically do not apply during the period that their statute of limitations, as cited in 6511H, are suspended. And the key meaning of the word is, what does suspend mean? And I think that that's a nuance that maybe all of us initially in this case overlooked, is that both the FTB and perhaps me as well in my responses, a suspension really is just that. It's a stoppage of the tolling of time. And in the case of a financially disabled taxpayer, the key question then becomes one of, if you will, a factual finding of when did they emerge from their state of being disabled and unable to handle their financial affairs. It's not a question here, I think we have all agreed, due to the finding by IRS that Jamie Hoover was found and is found here as being financially disabled and qualifying. Rather, the question addresses the interest payable on him due to the overpayments that he had with his FTB final resolution of all of his returns, both the original filed return and then the amended returns that our firm did. And my goal in appearing on his behalf today is to, if anything, help speak to this issue, because I think it's one, even though narrow, still deserves an understanding of application. And there are a couple of planks of law that reach this issue. As far as I'm concerned, one of them is taxpayer equity, which is perhaps the cardinal issue. Another issue, perhaps just as important, is one that's cited in one of the cases that I have included in my new material, which cites a Supreme Court doctrine called the avoidance of injustice. And the avoidance of injustice is more applicable to a financially disabled taxpayer than it is perhaps to most, only in the sense that for a period of time, and in this case it was approximately 6 to 8 years, I can't remember precisely, but I'll find it later, he was unable to speak for himself, act for himself, do anything for himself. And it took ultimately the assistance and the care of the woman that he married in 2010 to bring him out of that condition. He was afflicted with ADHD, which is a little understood condition in adults. It's very present in children, but to have an adult be an ADHD, to be afflicted with that disease is not normal. It's not often identified. It can be comorbid, meaning it presents with another condition at the same time, and it has to be readily addressed. Jamie Hoover is under a pretty good condition today and consistent status of awareness because he's being treated with drugs, and it's helping him. So that said, the wife's letter goes back in time when she first met him and what he was like, and she also addresses what he's like today. The analogy that it's okay to remit or reimburse a taxpayer for the government's use of their money while they're financially disabled to a situation where they have to then late file and they don't get it is saying that we're going to punish them for having been disabled in the first place. I don't think that is a fair application of the statute that goes along with being financially disabled. It's a punitive measure that ought not to apply. In my mind, it's analogous to seeing a blind man on the street who's selling pencils and going and taking some of those pencils and maybe using them halfway and then returning them later because he won't notice and saying, well, I'm sorry, we gave you back some of your pencils because we used half of them, but you won't notice, and we're going to do this against you because the code says we can. Well, sometimes because the code says we can does not mean that the code should be applied. So when I was analyzing this issue for today's hearing, the first question that I tried to solve is, what is the due date of a financially disabled taxpayer for a return that's filed late? What is that due date? I really don't think it's defined anywhere. I looked, and that's why some of the cases and the rulings that I cite are so old, is that the law ranges in the history on interest overpayments, mostly federal, or only federal, I should say here, go back a long way. And it is an issue of equity, that's clear. So when does that issue of equity stop. And we say, well, the taxpayer, while still deserving an equitable treatment, is now normal. And the only finding I could come up with is that the date of file or the due date was when that taxpayer became capable after having been incapable. Because there is no other way to state normalcy unless we know that he was abnormal for a while. And speaking of when he came out of it, and I write in my 6-page summary, that when one has a disease, when a human has a disease, we don't just wake up one day and we're healed. We are cured, our bodies cure us over a period of time. This applies to the common cold, it applies to cancer, it applies to a stroke, and just about anything that is a disease. So citing that specific date, as we discussed in our pre-hearing phone conference, as you mentioned, Judge Stanley, is it's not simple. So because I can't find a date other than the date that he filed, that would be my position, that is his due date. And if that is his due date, then he would then get, statutorily, as most taxpayers get, a 3.5-month period to file. Because if you will, the due date, or the first date one can file, like a 1990 tax return, would be January 1st of 1991. And then they get, without extension, 3.5 months up until April 15th. So that's the normal due date without extension. So what I have opined as a supposition here, or imagined due date, is that Hoover's due date was 3.5 months after the dates that he overtly filed his late filed tax returns due to his financial disability status, which is not argued by any of us. So imagine, if we will, that we had another case that came in here next week, had this very same issue. We'd have to answer the same question all over again. Part of the statute in 6511H and also 19316 is that the taxpayer stands alone in this issue unless they have someone to help them, who can help them. That would be normally a spouse. Jamie Hoover did not have a spouse. He was divorced early on and separated in the period of his disability. His ex-wife actually stole money from him after they were divorced. She stole $600,000, which is what the federal case and the state cases were about in the amended returns, and that was deemed to be illegal theft. That's how out of it he was. He once had $1.1 million in his bank account, and he went to the grocery store apparently sometime in 2006 or thereabout and tried to use it for groceries. And his $1.1 million was gone. And that's because his ex-spouse had taken $600 and FTB had levied the remainder of it. He was never aware of any of it. It's a small indication, but a large one, of how out of it he was. So, due date is an issue. Date of file is another issue. What is a late file return is another issue, or legal plank needing determination. When do a taxpayer's payments qualify legally as an overpayment? An overpayment in federal law is defined as when the amount of cumulative tax paid exceeds the final tax liability. And in Jamie Hoover's case for California, that happened very early on because Franchise Tax Board will normally assess on the amount realized. They'll create a tax liability when they have to file a substitute return, as does IRS, because they don't know what basis is. They have to do it that way. That's fine. But that's what they levied on, and therefore there was an overpayment. In the case of IRS, just as a side note, we may or may not have this issue of the tax years being overpaid, simply because when it was all said and done, all the years were settled, Hoover had to pay IRS $150,000. So IRS never levied him for some reason, and FTB did, which is why we have a difference there. The way that an overpayment is applied in federal law and in California law is that statutory interest is due unless otherwise accepted or limited for some reason. So that's why I feel that the application of the limitation section under RTC 19341D is not applicable here, because in order to do so, FTB must then prove without a doubt that the due date is a normal due date for this taxpayer. I don't think that that can ever be done based upon the facts. A federal overpayment as well, in one of your the cited things, Revenue Ruling 75-315, is defined there when there is in fact no due date. So if there's never a due date, when is the overpayment entitled to interest? And that would be when it is an overpayment, when it exceeds the amount of settled tax liability due. I think that in sum, that would be the gist of what I have to say, is that we, in a way, face a difficult decision. Because, and I'm here along with all of you. I represent taxpayers. I file truthfully as a practitioner. I recognize with the tax law that we live by all parts of it. If we agree that we like some, we have to accept the others that we don't sometimes think are right. And I'm not, by my own mind, I'm certain what the right decision is here, and that's to avoid injustice to this taxpayer. Because I think it would be unjust to apply a section intended for normal practice and filing enforcement upon a legally incapable filer at the ordinary due date. And that's the end of my comment now.
Okay. Before we proceed to your response to that, I did have one question. I don't know if my fellow judges do yet, but you agree, Ms. Powers, that your client was refunded overpayments plus interest beginning at least on the date of his filing?
Yes, we do. He was very grateful for that refund.
Does anybody know the amount even at issue here? We didn't have that in any of the documents that I saw.
We tried to do a quick calculation of it. It's somewhere, I think, more than 100,000 and less than 300,000. I know it's a very broad range of numbers, but as I mentioned in our pretrial call, I had a long scheduled vacation and I returned 5 days ago, so I'm sorry.
Okay. Before we proceed, do you have other questions of Ms. Powers?
Is there any legislative history or showing that 19341D was intended to be punitive?
I think by nature, no, I don't think that's true, but I think just by common understanding, it's not a reward. It's a taking away of interest on money the government was holding. It is punitive by definition and operation.
Okay, because I know that sometimes when you have, when you make a claim from the government, they give interest from the date of the claim. So I think that might be part of the reason here. It may not be punitive per se, but the government may just want to know what liabilities it owes. And by filing a return requesting a refund, that might be the basis for they're saying, when you make a claim against me, I'll pay you a refund I'll pay you interest from the date of the claim, but I want to know how much I owe. So that might be an analogy here. I'm not sure.
I think your point is made, but I still maintain that that section does not apply to a suspended statutory taxpayer. I mean, his limitations are suspended. All the limitation provisions are suspended until they are out of that condition. Therefore, it cannot be applicable.
Nothing further.
Do you have any questions?
I believe in some of your briefing you had mentioned that the IRS allowed payment of credit interest for the period starting from the date of payment. Is that correct?
I think it may have in certain of the years. Frankly, we had not looked at that issue first. We looked at this one immediately because I was unaware of 19341D. We filed the claim for Jamie Hoover with Franchise Tax Board. And then when we received the notice that it applied. And that's said with no disrespect to California law at all. It's just that having a whole separate code section on top of a federal set of laws is a lot of code sections to know about. So I was not aware of that section. But I think that IRS may have had an overpayment in some of the years that it did not credit the taxpayer for. And now that I am aware, in a way I never thought I would be, of the applicability of these provisions, we will look again at the IRS record. And if there is anything there to claim for him, we'll probably claim it.
Okay, and does the FTB have an opinion on the matter of whether the IRS gave credit interest for the period starting from the date of payment?
Well, it looks like for 2006, overpayments for the appellant were dated from the original due date, original return due date. Appellant has conceded that the IRS audited 2005 and 2006 tax years. And during those years, there was an appeals conference, and looks like there was a settlement. So the allowance of interest from the original due date for 2006 may have been a part of the settlement with the IRS.
It was not. Thank you, though.
There's no evidence in the record that the dates for which interest was allowed by the IRS in any event, regardless of the dates for which interest was allowed at the federal level, has no bearing on the interpretation of the state statutes in this case. We don't know what happened at the federal level, and we don't know why what happened. So our position would be that it doesn't make a difference no matter what.
Okay, thank you.
And can I speak or not?
Yeah.
I'll wait.
No, go ahead.
Okay. Say that I don't think that the two situations are entirely comparable, because with a federal case, when it was all said and done, and what IRS does and FTB will do as well, is they will apply, when they have a group of returns, if there's an amount outstanding, a collection outstanding on one return, they won't refund the taxpayer. They'll just apply it to the year where the money is due without refunding it directly to the taxpayer. So they refund it, but indirectly through its agency. And in the case of IRS, when it was all said and done and all the credits and refunds back and forth were done, Jamie Hoover had to pay IRS either $125,000 or $150,000. In the case of FTB nominally, at least with the first filing of interest in our claims and the refunds, owed Hoover, $700,000 or $800,000. And it paid about $535,000 originally. So, but that's because, as I said earlier, the FTB had so excessively levied him, and IRS had not levied him at all. When he first walked into our office, as referred by another CPA, his total assessments for both agencies came to well over $2.5 million.
All right. Would you like an opportunity to make a closing statement?
Yes, please.
Okay. Proceed.
Revenue Taxation Code Sections 19316 and 19341 operate independently. Therefore, appellant is not entitled to any interest in addition to what has already been paid to him. Section 19316 provides an exception to the general statute of limitations for filing a claim for refund based on a finding of financial disability. That's all it does. It serves an important function by creating an extended claim filing deadline under certain circumstances. In this case, respondent's finding of financial disability enabled the appellant to file timely refund claims for tax years 2001 to 2004. Unrelated to a claim filing deadline, Section 19341D addresses circumstances under which interest will not be paid on refunds. Section 19341D provides, in the case of a return of tax which is filed after the last day prescribed for filing the return, determined with regard to extensions, no interest shall be allowed or paid for any day before the date on which the return is filed. In this case, because the returns for all tax years were filed late, respondent was prohibited by Section 19341D from allowing interest on overpayments before the dates the returns were filed. Section 19341D does not provide an alternate prescription based on the presence or absence of financial disability. Sections 19316 and 19341 are standalone statutes, and they are clearly written. 19316 applies to the statute of limitations for filing a claim for refund. 19341D applies to when interest is not allowed.
And as FTB discussed in its opening brief on page 12, if you look at principles of statutory construction, they fully support FTB's interpretation here. And when you are looking at interpreting state statutes, the California Supreme Court is the final word on interpreting them. And in the case of Linane versus the Franchise Tax Board, a 1994 decision cited in our opening brief, the court set out the rules to interpret statutes. The first thing you do is look at the language, and you give the words their plain meaning. Plain meaning of Section 19316 is that under certain circumstances, a statute of limitations for filing a claim, refund claim, may be extended. The plain language of 19341D is that the state is prohibited from allowing interest on overpayments under certain circumstances. And those would include specifically the dates on which late filed returns come in. And we'd note that it's section, the appellant seems to be concerned about not understanding what the return filing dates are, the due dates are under California law. Revenue Taxation Code section 18566 answers that question and says that for personal income taxpayers, the returns are due on the 15th day of April following the tax year at issue. So we start there and then we say, well, what did the legislature intend? And because we presume that our legislature understands what it is doing when it enacts statutes. Section 19341 was enacted in 1993. Section 19316 was enacted almost 10 years later. Had the legislature intended for Section 19341D not to apply when a taxpayer's refund claim is filed within a statute that's extended because of a determination of financial disability, it could have, at the time it enacted Section 19316, added language to that section to indicate that 19341D would not apply when the refund claim was filed pursuant to that section, or it could have amended Section 19341D to the same effect. It did neither. So, pursuant to California Supreme Court guidance and determination, FTB has properly determined that these statutes stand alone and that it is in fact prohibited by 19341D from allowing any interest in excess of what has already been allowed.
Because appellant filed his 2001 to 2006 returns late, FTB properly allowed interest on the overpayments only from the dates that he filed those returns, pursuant to 19341D. There's no statute which authorizes there's no statute which authorizes respondent to allow interest on the overpayments from the date appellant filed his returns. Section 19316 does not govern interest, and Section 19341D clearly prohibits it. Therefore, respondent respectfully requests your office sustains this action.
follow-up questions?
I guess I'll just ask you the same question I asked Petitioner's Counsel. I mean, is it your position that 19341D was intended to be a punitive statute, or?
There's no evidence that it was intended to be a punitive statute.
Okay, thank you.
So I think the appellant had been arguing that due to their financial disability or medical condition, their due date was extended, and I'm just wondering if the Franchise Tax Board would like an opportunity to address the concern of whether or not, because of the financial condition or medical condition, the time frame to file a return could have been extended.
As mentioned, Section 18566 provides the deadline for filing a return, and there is no exception to that deadline based on a financial disability.
Thank you.
So if you're saying that there's no exception to that deadline, then and that 19316 is only a extension of the time to file for a claim for refund, then why is it that he's relieved of late filing penalties?
That could be, well, late filing penalties, late payment penalties could be a cause. So the finding of financial ability, the facts for that could constitute reasonable cause to abate those penalties.
I think in this case that because at least I think for all tax years, Franchise Tax Board had taken filing enforcement action, and there were filing enforcement assessments that had become final, and those would always include late filing penalties. At the times the original returns were filed, and then perhaps the amended returns, the calculation of a late filing penalty under Section 19131 may have been a calculation based on the revised amount of the tax liability of $0, because the penalty is calculated as a percentage of the amount by which the tax liability was unpaid as of the original due date of the return. So if it turns out that there had been withholding or other payments as of the original due date of each return that exceeded the liabilities that were established either by the original or by subsequent amended returns, then the late filing penalty under 19131 would be recalculated, and if it turns out there was no underpayment of the self-assessed or amended self-assessed liabilities, the calculation would be $0.
And that would apply for the 19131, but not the 19133 penalties?
Correct. 19133 demand penalty is not calculated based on underpayment of the liability as of the original due date.
So, and the reason that Franchise Tax Board wouldn't have charged him for that would have been that they consider financial hardship to be reasonable cause to abate penalties.
Well, the standard under the law to abate the late filing or a demand penalty isn't financial hardship. It is reasonable cause, but it can't, specifically in the case of a late payment penalty, financial hardship can constitute a reasonable cause, but that penalty isn't, I don't know that that penalty is at issue here. I can tell you, though, that with respect to looping back to your question about why, if we allowed we allowed the late filed refund claims as timely because of financial disability, why that wouldn't constitute reason to abate the late filing penalty. I'm not sure, when all is said and done, that there are late filing penalties on any of these tax year accounts.
Thank you. Would you like to follow up and have the final word, Ms. Powers?
I would. Thank you. Going back to part of what he said here, Samantha said. She said that 19316 and 19341 are not related, and I feel they are absolutely related, because when you have a taxpayer who's been suspended or excused from filing until they're capable of filing, and that condition, by the way, is called being financially disabled, which I'll distinguish later in a minute as it pertains to the definition of financial hardship in regard to penalties, because the two are different. But they are directly related. When that taxpayer is able to file is then when 19341 would come into play. While they're suspended, they're suspended. If a simple analogy is, if I am late for class and I ask the teacher if I can come in late, the teacher can't reprimand me once I show up late if they first said it was okay that I be late in the first place. You cannot have it both ways. And that's in a way what is trying to happen here at the FTB level, is that by saying that these two statutes are not related is ignorant of the necessity of defining a due date and a late file date in anybody's case. The other is, I want to point out that this issue of statutory construction is one of a wish. We all wish statutory construction was perfect. It never is perfect. It never will be, because laws happen, they're written, and they have to then be applied to circumstances that were not foreseen at the date the statute was written. A simple example of that is that when the section for following, an absolute following by FTB of the federal determination was added to 19316, and that did not happen until I think 2 years ago. So 19316 has itself been adjusted or amended in later law, and there is some specificity in the statute right now about what other California code sections it relates to. And those things only happen because of hearings like this one, that we learn, oh yes, this is applicable. It's very difficult to imagine the application of something once you decide it's a good principle to write a statute on, or a good general rule, or for ease of administration of collection, etc., all the reasons that we do it. The other is even Linane was decided in 1994. That's 8 years before 19316 was created. So you would hope that when the people wrote 19316, the legislature wrote it, they would have thought about it. I don't think that they did. I was at that hearing, as you know, by the data that you have in your file. I brought the case that created 19316 for California, which is called the estate of Jenny Pappas. And there was literally zero authority on the record in the RTC about a financially disabled taxpayer. I brought it anyway, and we won at that hearing, and they wrote 19316. And the head of the panel, which was the SBOE, your predecessor agency, at that time, and it was in 1999 or early 2000 when this hearing happened, said the feds had just passed what he called an elder rule 2 years before that, and that we needed one too at the California level. And that's how this statute was created, was by the estate of Jenny Pappas' case. And that was an 84-year-old decedent who'd been semi-conscious for 9 years before she died and had not filed. There were other facts that aren't pertinent. So I only raise this to say that the notion of statutory construction is not always applicable either in every case. The other thing I would say is that with IRS, there is an overpayment, there's interest payable on an overpayment at the date it exists, and that can happen as in Rev Rule 753515, as well as in the case cited, which is MNOPF, which stands for some trust agency of the Navy. And where there is no return required, there's interest due statutorily under 6513, I believe they cite, when the overpayment exists and is paid and remitted, less the dates needed by the government to refund them. So it's not so hard to find a legal overpayment. It's just, in this case, removing this punitive measure of 1934D, 41D. The last thing I would say is about the penalty abatement. That was not automatically given by Franchise Tax Board to Jamie Hoover. We asked for it, and it was agreed that we were able to get those penalties removed under reasonable cause. They were not removed, as I recall, for being a hardship, financial hardship, because Jamie Hoover didn't have a financial hardship. He was one of the original programmers for eBay and Yahoo. He's brilliant and was brilliant at what he did then. And then his life went to pieces. And now he's not quite as brilliant as before, but he's functional. So, just as a point, there was no financial hardship found in this case. There was, however, financial disability. That's it.
Okay. If my fellow judges have no other questions, no? Okay, I'm going to close today's record, and if we do decide that after we review the materials that were submitted late, if we need additional briefing, we will reopen for that purpose only. If we do not do that, you can expect a decision within 100 days. And thank you.
Thank you.
Thank you.